we're now live. It's like, you know, when I go on TV, they take me to makeup first, but we don't seem to do that here. And I guess they didn't take you to makeup either, right? So
you also don't have a teleprompter here, so...
I don't have teleprompter when I go on TV either. Not that I go on TV that often, just to be clear. All right, so good afternoon. So for the next couple of hours, we're just going to kind of try and review what I think of as the key messages from global business economics. And I'm going to try and do sort of a mix of kind of the big picture things and also certainly the tools that I think are kind of critical for the exam. Although the way the exam is written, it also should have a bit of a mix of the big picture things and the tools as well. And I will also take a little bit of time just to kind of go through the practice exam that I gave you. So, as I mentioned in the email that I sent out yesterday, there's a couple of documents that are now available up on LMS. One is this final debrief document, which kind of takes the debrief that I gave you for the midterm and then adds everything that we've done since there. And also, I have added some kind of technical details. Just there's actually not a lot of really technical material for global business economics, but I've stuck a few kind of pages at the end, just running through growth rates, running through the absolute key things of the aggregate expenditure model, of the basic arbitrage equations, and so forth. Let me, before I start on any of this, just talk a little bit about the exam structure. So I invited your feedback on the practice exam, and a few of you got back to me, for which I'm grateful. Thank you for that. I didn't get a lot of comments back, which I took to mean that, I don't know what I took it to mean. I think I took it to mean that most of you weren't too terribly scared by the format of the exam. But I did get, and I was a little bit concerned about this, and I did get some feedback suggesting that the exam was perhaps a little bit long for kind of the 2.25 hour period. So I'm going to shorten it a little bit. So let me just tell you what the exam is going to look like. It's just going to be a little bit different from what I gave you. So as before, there will be a part A. With 10 questions. And I'm going to ask you to answer 7 of those rather than 8. So there's going to be one less question and therefore also a little bit more choice. And then part B, it's still going to be just one question, but I'm going to give you some choice as well. And in terms of the points allocation, the way it was before, basically there were these, you had to answer, previously you had to answer 8 questions, and then there was this longer question, which was kind of in points term equivalent to like 4 more questions. So that was kind of, one way of sort of thinking of it, was the whole exam was sort of about the length of 12 of these small questions, if you like. What I'm going to have now is, these will be each at, I guess I'll do it out of 100, so that will each be 10 points. So that'll equal 70 points, and then this will be 30 points. For a total of 100. So what that also means is this second long question, instead of thinking of it as being kind of the equivalent of 4 of the short questions, I'm now thinking of it as being the equivalent of 3 of the short questions. So that's also a shortening of the exam, if you like. So, I mean, the exam was basically kind of the equivalent of 12 small questions before, and now it's the equivalent of 10 small questions. Does that make sense? So the exam will be a little bit shorter. There'll be a mixture in these short questions. I'm really trying to mix it up, so some of them are about interpreting the data in the case. So some of them are about really, can you look at the data in the case and interpret it? Some of them will be about, can you kind of read bits of the case and then make sense of what the case is saying in terms of some of the frameworks that we used in the class. And then some of them will be, a couple of them will be a sort of a more kind of calculating style questions using some of the frameworks and models that we have. So it's going to be a mixture of kind of data interpretation, textual interpretation, and just a little bit of applying of the models. So before I get into actual review, any questions about that exam format? Does that make sense? Yeah, that's fine. Yeah, so you did write me an email, and I almost sort of mentioned your name when I was talking about these. So in this kind of review I have of the whole class, I basically wrote kind of these 4 pages, and for me those were kind of the key formulas. So essentially what we have here is, first of all, the basic kind of mathematics of growth rates. And then in terms of those formulas, I won't run through them all now, but just to kind of indicate what they were, sort of the key ones were sort of the quantity equation, and when we use that in terms of growth rates, that allows us to understand kind of long-run inflation and how that relates to money growth. There's the growth accounting equation, where we start from the Cobb-Douglas production function and then go through that. And then, in underneath that, there's sort of understanding productivity and measures of productivity. There's understanding the changes in the real exchange rate, and I also added something about kind of government debt and sort of the basic dynamics of government debt. So those formulas there. For the aggregate expenditure model, there's really just sort of a couple of key equations, and then the equation for price adjustment, and then really just, I think the key formulas are like understanding the real exchange rate, the Fisher equations are relating real and nominal interest rates, maybe the yield curve. I put it in there, although we didn't talk about the yield curve a great deal, so I wouldn't be likely to make it an emphasis in the exam. And then the uncovered interest parity condition. So for me, I think that's kind of the list of what I would view as all the key formulas. And they're all now as part of this final debrief document. Yeah?
Written submission or on the laptop?
Sorry?
Submitting on a laptop.
No, it'll be handwritten. You can put whatever you like on the cheat sheet. So the cheat sheet is 4 pages. You can put whatever you like on that. I had a question about whether you can annotate the case, so I'll distribute the case in advance. And basically my answer to that is I'm happy for you to annotate the case as long as you don't go kind of crazy about it. So, you're welcome to highlight, you're welcome to underline, you're welcome to kind of write a few notes in the margins of the case here and there. But, I wouldn't expect, if I wanted to sort of be kind of quantifying this, I wouldn't expect you to write more than like 100, 150 words total on the case. Not that I'm going to go around and collect your cases and count up all the handwritten words, but just to give you sort of an idea of what is reasonable. And so does that seem fair? You can take the case if you want to print it out and you want to put some notes on it. You don't have to do that, but if you think that would be a useful thing to do, then you can do that, and that can take the form of highlighting, underlining, and occasional kind of short notes in the margin. But anything longer than that should be finding its way onto the cheat sheet. Cheat sheet is, as I say, 4 pages, which I think should be more than enough for you to put down everything you need. Yeah, Dan.
What day do you get the case?
What day do you get the case? So that was also something that people had sort of very different opinions on. What I'll do is I will send it out to you on Friday. So probably Friday morning. So you will have the full weekend to look at it. Some people kind of thought that it would be good to have it earlier, but actually the general sentiment seemed to be that people just kind of felt if they got it earlier they would worry about it more. So Friday is the case. Any other kind of questions about? Yes?
If you have some extra time on that, can you do some extra questions and have the best 7 count?
No. I'm very dedicated to my job, but look around you here in the room, and if you could, just for a moment, put yourself in my shoes. I have a pretty short window between this exam and when we have to meet for the examiner's board. I'm going to, at the point where you all go off to the Corkman and start drinking, that's when my misery really begins. And if this were to turn into, 10 questions here and 2 questions here, so what you should do is you should, take a bit of time, really figure out which questions you think are the best ones to answer, and then only answer those. And if you end up answering one and then deciding you don't want to use it, make that very clear. Cross it out so that I don't think that you want to use it. Yeah.
And do all the questions relate to the case?
All the questions will relate to the case, yes, although in some cases they'll be sort of very focused specifically on the case. Some might be a little bit more general, just kind of starting from the case, but yes.
Do we need to refer to any other countries in the study?
No. Okay, no, that's a very good point. You do not need to, you will not be examined on any material from the other countries. You're certainly welcome to reference those if you find it's helpful, and in some case it might be. If you were talking about a hyperinflation or something and you wanted to relate it to Argentina, you can, but you will not be tested on any of the materials from those cases. So, I mean, the way I think about what this course is about, in some sense, is it's about country analysis from a particular perspective, from the perspective of macroeconomics. And so what we've been working at by going through all of these cases over the course of the term is getting some facility at being able to read stuff about a country, look at data from a country, and actually think about what that means and have a bit of structure and framework to kind of make sense of it. So, for example, that this may be directly relevant for you. Some of you in your jobs now or in your jobs in the future when you might be making decisions about sourcing from different countries or joint ventures with different with firms from different countries, or even establishing operations in different countries. But it's also about, can you read the AFR and can you read the Economist in an educated way and figure out when they're making sense and when they're not. So what we've been doing over the course of the term is trying to learn how to look at information about countries and make sense of it, and that's what I'm trying to test now in the exam. And so that's why I've gone with this format of the exam, and as I told you, I've changed this from when I last taught the course in response to feedback that I got from previous classes, and made the exam much more about this interpretation of country data and much more related to the kind of the country discussions that we've had, and a bit less on just sort of the mechanics of, say, the aggregate expenditure. Other questions? Yeah.
Will the country in the case be a country that no one's done the presentation, or?
Yes. No. That would. Anything else would be very, very unfair. No. The country in the case will not be one of the however many we've studied, what, 7 or something, or 6 or 7 that we studied in the course, and it won't be any of the 20 that have been covered by the groups in either section. So that leaves, what does that leave? Something like, 160 something countries still that I'm choosing from. So you probably still can't guess.
North Korea.
What? One other thing I was going to say about when I decided to do sort of the 2 questions here for the slightly longer question, one of the pieces of feedback I got was that the question that I wrote was for the practice exam was fairly open-ended, which is true, and in some ways I thought that was a good thing because it would allow me to kind of show you, allow you to show me kind of what you learned and what you understood, but I can see that might also be a little bit, I don't want to say scary, but when you get an open-ended question, it's sometimes less clear what you're going to do with it. So actually, the 2 questions I'm going to have here, one will be kind of, I think, more specifically focused on something in the case, and one will be a bit more open-ended. They'll both be about the case, but one will be more open-ended. So there'll be room for you to kind of decide which kind of question you feel more comfortable answering. And actually the open-ended one, which I've written, the other one I still haven't written, but the open-ended one I've written, it's very open-ended. And more than that I won't say.
One of the things with an open-ended question is that you can go down one path or a different path, and presumably you won't have a correct answer in mind because you could potentially go the wrong way.
No, with that, yes, it's not about there being a correct answer, it's about saying sensible and insightful things. Okay, and the sensible, insightful things could possibly be in this direction or be in this direction. Absolutely. All right. So I think what I should focus on, because I did do this I did do a review around the middle of the term, and I think I should probably focus mainly on the material that we've covered sort of from that point onwards. But if you have questions that go back to the earlier material in the term, you should certainly feel free to ask those. So I did a review somewhere around, I think it was session 5, where I kind of reviewed the stuff that we've done on kind of accounting and growth and things like that. And so what I'm planning on focusing on today is really the material that we've covered in session 6 and beyond. So again, just kind of working from this debrief that I wrote, what are the sort of topics that I'm going to find, eventually I'm going to find a pen that actually works here. What are the sort of topics that we can potentially talk about? Well, one will be, I'm just going to list some things here.
Do you need one? Because I used to.
Now, keep trying.
Well, this.
That's scary.
This is the second term in the school.
Just pick one.
Actually stole from the customer, so I can have them.
Beautiful. Beautiful.
That's the same joke twice. I did it on the manager as well. They still haven't fixed the model.
I know. Actually, for a long time I had my own set in my office, but then those got stolen. So, and they don't pay me enough to replace them. Thank you. Okay. So, one topic is obviously sort of exchange rates and the kind of things that we might want to review there and the purchasing power parity exchange rate. Over and under valuation. The real exchange rate, and then the uncovered interest parity condition. So I will review those topics. The aggregate expenditure model, I'll just talk a little bit about that, and again really try and make sure we understand what the purposes of that model, why we study this model, what we can use it for, and reviewing monetary policy and fiscal policy. And when we review monetary policy, that will also kind of take us back up to exchange rates, because one of the things there is fixed versus flexible exchange rates. And the impossible trinity. So I'll review those topics. Short run inflation and price adjustment. And I guess also on fiscal policy, topic that we just talked about earlier this week. Long run sustainability. So I guess I see these as kind of the key topics that we've covered in sort of weeks 6 through 9. Best I remember. I can't think of anything else important that we've done there. So my plan is to kind of talk through these things. Anything else that you think of right now that you might like me to talk
Will
about?
you cover price adjustment when you talk through the aggregate expenditure?
Yeah. So yeah, that's the last thing I said. Yes, I know.
You talk about lag effects when you talk about multiple things.
Yeah, I'll maybe say a few words about lags here. I think that's an important thing to review. Okay. All right, so let me just kind of run through some of these topics, and then I'll come and I'll talk a little bit about the practice exam. Basically go up to about there. How well, I don't want this entire thing to be focused on the people who are going to be watching it afterwards. How well can you see if I'm writing in this space? Can people see? Okay? All right. Focus things in that space. All right, so let's maybe start with the aggregate expenditure model. And let me again start with the big picture idea here before I get into the technicalities of the model. So the big picture is that we're trying to understand short-run fluctuations in the economy. So when we first looked at data for economies, when we looked at Australia in week 1 and Singapore around week 3, one of the things I had you do was to look at kind of the behavior of nominal and real GDP over time. And what we typically see in most countries is we see real GDP or nominal GDP growing, but that growth isn't smooth. It fluctuates, it bounces around. Sometimes we see the economy growing very fast, sometimes we see the economy growing much more slowly, or even shrinking. So sometimes we actually see less GDP being produced one year than was being produced the year before. And that's what we would call a recession. So our theory of short-run fluctuations is about trying to make sense of that. It's trying to make sense of what happens to economies that causes us to sometimes have booms and sometimes have recessions. And the fundamental idea is that short-run fluctuations are driven from the demand side of the economy. So we know that GDP measures production and income and spending. When we think about long-run growth, we focused on the supply side of the economy, our ability to produce goods and services. We focused on the aggregate production function. But when we're thinking about what's happening in the short run, we think that it's fundamentally being driven by what's happening to spending. So in the short run, the story is there are shocks to spending, and these shocks can come from various places. So they might be kind of psychological, around expenditure and confidence, around expectations and confidence. So one sort of view of where fluctuations come from is that, either business people are sometimes more confident about the state of the economy or less confident about the state of the economy. John Maynard Keynes, who kind of first said we should focus on the demand side of the economy, talked about animal spirits. He kind of had this belief that business people would sometimes wake up in the morning feeling good about the economy and they'd want to go out and invest like crazy. And then the next day they'd wake up feeling really pessimistic and they decide they didn't want to invest at all. We don't these days think about business people as necessarily being quite that kind of fickle and irrational in their decision making, but we do still think business expectations can be an important driver of the economy. And consumer expectations, consumer confidence can also be a driver. Sometimes, for whatever reason, people feel confident about the state of the economy. Sometimes they feel more nervous, and that might be driven by non-economic things. It might be driven by kind of other things that are going on in the world. Maybe sort of the events of that we've seen recently in Paris and in other places have people just feeling a little bit less secure about the world and therefore a little bit less willing to spend. Certainly those kinds of shocks can sometimes have a negative effect on the economy. So some of this could be kind of somewhat around expectations and confidence. Some of it might be to do with wealth shocks. So when, say, there's a big housing boom going on, people are seeing the value of the homes that they own going up. So they feel like they're becoming wealthier because of that. Or when the stock market is booming, people feel that they're becoming wealthier. That may lead them to be willing to consume more and save less. But if there's kind of a stock market crash, or if there is housing crash, people would suddenly start feeling less wealthy, and they would be more inclined to save and less inclined to consume. So wealth shocks can affect the decision between consumption and saving, which is obviously a fundamental decision in the economy, and so might also be a source of shock. What else? Foreign shocks. So shocks to net exports. If the Chinese economy starts performing less strongly, that may show up as a negative shock to the Australian economy because our exports to China would tend to go down. So we think about there being these kinds of shocks, and then, well, yeah, actually no, let me leave it like that. And what happens with these shocks is then we have a multiplier effect and sectoral propagation, which says that the shocks that we see hitting the economy can end up being, first of all, magnified, and secondly, being spread throughout the whole economy. So even if they start off in a particular sector of the economy, so if we had a shock to investor confidence, that might start off in the sectors that produced investment goods, that were producing new capital equipment. In the end, it's going to get propagated through the whole economy. And the story of that propagation mechanism comes from the circular flow of income. Okay, so the circular flow of income says that we have these various sources of demand for the goods and services that farmers produce. Consumption, investment, government spending, and net exports. Those are the sources of demand. If we have a negative shock to any of these, so for example, if we had a negative shock to investment, firms are going to find that they have less demand for the goods and services that they produce. They'll first of all see that as a build-up of inventory. That build-up of inventory will be a signal to them that they need to scale back production. So they will start to scale back their GDP. That means less income in the hands of households. And that in turn means less consumption. Households see their income go down, so now they're going to consume less. And now, that shock is going to be spread to all the places where households spend their money. So originally maybe, it was an investment shock that was affecting firms that were producing new capital goods, new machinery, building factories or whatever. But now all of a sudden, we've seen workers in those industries being laid off or having less income. So now everything that those workers would spend their money on, new cars, restaurant meals, coffee at cafes, new clothes, all of those things, all of those sectors of the economy are going to get affected as well. So you get the propagation across the different sectors of the economy, and also this multiplier effect. You see spending goes down, so income goes down, so spending goes down further, so income goes down further, so spending goes down further, so income goes down further, and so on and so on. So the original shock to the economy gets magnified and multiplied. That's the multiplier. And then we potentially have a policy response to this, which will take the form of monetary policy. which is basically about changing interest rates. Or fiscal policy, which is about changing spending or taxes. And the idea of this is that we may be able to have stabilization in other words, we may be able to, with a well-crafted monetary or fiscal policy, we may be able to respond to the shocks that hit the economy and have their overall effect on spending and therefore on production and on other things we care about like unemployment. That overall effect may be lessened if we can design a sensible policy. Our ability to design that policy does of course depend on the lags which we've also asked about.
So this is interest rates, obviously they can change the nominal one, but what they try to do is to affect the real one.
Absolutely, yep. And my answer is yes.
And so that one is actually nominal one.
Yeah, so no, I mean, it's a really good point. So the policy response here works through the monetary transmission mechanism. Okay? And the monetary transmission mechanism, I will review that, but it's essentially about how, or at least a part of it is about how we control a relatively short-term nominal interest rate, but what we ultimately want to do is to affect a more long-term real interest rate. That's absolutely. Okay, so that's kind of that's the sort of story you should have in mind. That's your understanding of kind of how the economy works in the short run. This is kind of the flavor that it should have. A sense that the economy gets hit by shocks that are somewhat unpredictable. Those shocks are sometimes psychological, around confidence. There's sometimes real shocks around, say, changes in stock market values that affect wealth, or shocks coming from outside the country that affect the ability of people to export. The economy is hit by these shocks. There are multiplier and propagation mechanisms that can magnify those shocks, and there are potentially policy responses that ideally at least can serve to mitigate those shocks and keep the economy more stable than it would be otherwise. And this again is all about kind of what's happening kind of around the long run growth path. So we've got a long run growth path, that's where the economy will eventually get back to, but it's fluctuating around that, and we'd like those fluctuations to be smaller rather than greater. These kinds of policies, monetary policy and fiscal policy, these stabilization policies, these aren't ultimately going to affect the long run growth rate of the economy or long run inflation, because long run growth and long run inflation are driven by our accumulation of the inputs to the aggregate production function. Long-run growth comes from building up our physical capital stock, building up our human capital, building up our social infrastructure so that we become more attractive places for businesses to locate. But short-run growth, short-run fluctuations are driven by these kind of things coming from the demand side and the spending side. Any questions about that before I kind of briefly review the details of the model? Yeah.
You just separate those two things out completely, but surely the policy response, if you have an extended period of say, cheap money, that will have an impact on the long-term It may not be a significant impact, you know, if it fluctuates up and down because they balance each other out. If you've got an extended period of say, extremely accommodative monetary policy, then doesn't that have an impact on income?
So, lots of things I could say in response to that. It's a very good question. So, let me make a few observations about that. So if you've got, let me answer your question, it's a direct question, which is if you've got very accommodative monetary policy, what does that do? Essentially, what that does or what that risks doing is meaning that in the end the money supply starts growing faster than is consistent with what we'd like to achieve in terms of long-run inflation. So where we would expect that particular issue to show up would not be in changes in the long-run growth rate of the economy, but possibly in changes in the long-run inflation rate in the economy. So one of the problems that you can have if monetary policy is too accommodative for too long a period is that you start having the money supply growing too fast and you start to see inflation getting out of control. But there are also other ways in which we might actually see connections between the short run and the long run. So one thing is that I haven't talked about very much, but there are also what are sometimes called supply shocks. We talked about this briefly in class, but not in great detail. So you can think about there being shocks to the economy that really show up originally on the supply side of the economy. So something like a change in regulations might be an example. A change in the degree of political stability in the economy, a change in the tax laws that affect the profitability of businesses and things like that. So there are lots of things that could show up here. That's just a few. There are other things that we can think about. Supply shocks we would generally think of as having both long-term and short-term effects. Okay. So they would show up in this circular flow of income as affecting the level of GDP, affecting the level of production, and still has some of these multiplier effects, potentially, and propagation effects showing up. Okay? So they will have effects both on long-run growth, but they will also be a source of variation in the short run. So that's one place that we can see these things being connected. The other thing that can happen is if we have economies that, for example, for whatever reason go into sort of protracted periods of recession, then that can have implications for particularly the development of human capital in an economy. So if we think about an economy like Greece that we talked about this week, or Spain, which was an economy that half of you here heard about a little bit about during the week. So some of these economies at the periphery of Europe that have been particularly hard hit by the Europe sovereign debt crises, one of the consequences of that is very high youth unemployment. We also saw that actually in the case on South Africa, if you remember. So very high levels of youth unemployment. Now, typically, we think that when particularly young workers are working, that's a time when they're developing a lot of skills. Okay, so a lot of human capital kind of comes from on-the-job training and on-the-job learning. So if you have got, 50% of your workers between the ages of 18 and 25 not actually in a job for long periods of time, that doesn't just mean we're not sticking the labor into the aggregate production function. It also means that we're not seeing the development of human capital that we might have. And we may also see workers seeing their skills gradually becoming obsolete as well. So we might actually see not development of human capital, but we might see sort of human capital levels declining as a result of that. So I think those kinds of connections between sort of protracted economic downturns and the implications for kind of skills, learning, human capital are a potential important connection between the short and long run as well. Okay, all right, so how do we capture this? We capture this in the aggregate expenditure model, and I'll just do one very quick review of that model again, because I will, because I think it's useful, because I don't know, it might or might not show up on the exam, I haven't decided yet. But I do want you to, again, sort of in the big picture sense, I want you to understand what this aggregate expenditure model is kind of trying to do for us. Because this is the model, right? This is the model that I've given to you. And from a mathematical point of view, this is trivial, right? From a mathematical point of view, this is representing the entire economy in terms of two equations, one of which is just the equation, of a straight line of slope 1 through the origin, which is about the simplest. It's like the first equation you learned in like 3rd grade when they first start teaching you equations. So this one's not a very, very hard equation. This one's not a particularly hard equation either. And in terms of the mathematics of this, it's all very simple and it's very trivial. And so it's reasonable to look at this and say, well, look, Andrew, you told us a sort of a nice general story about how the economy works. Do you really think that this captures it? And the answer is, of course, yes and no. And clearly it's not capturing all the complexities of the economy. Clearly it's not capturing lots of different stuff about how people behave and how firms behave, and things that we could use to build this into a richer and more complete model. And if you were to look at the kinds of models that, say, the Reserve Bank of Australia or folks at the Treasury use to try and understand the economy, you will be relieved to hear, not quite as simple and straightforward as this. They have more going on in them than that. In particular, they'll be more careful about kind of what's sort of about putting expectations in there. They'll be more careful about thinking about the dynamic behavior of the economy and how things evolve over time. They'll be more careful about specifying some of the underlying behavioral relationships, sort of how households choose their consumption decisions, how firms choose their investment decisions, and so forth. So all of that can be fleshed out in great detail. But my claim is that this, nonetheless, really does give us the kind of the flavor of how you can take this kind of set of words and description and turn it into something that's a little bit more rigorous and formal and that we can actually use for real policy analysis. So the story here is basically that we have a behavioral relationship which just says the planned spending has this autonomous component and then also a component that depends upon the level of GDP. The easiest way to think about this is that this is kind of a big part of this is consumption. we know, of course, that consumption in most countries is a pretty big fraction of GDP, 50–60% of GDP. So you can think about this as, largely, this relationship here is largely coming from the fact that consumption is going to be dependent in part on income. So when income goes up, people's consumption is going to go up as well. But there could also be other things that are dependent on income as well. Investment might be dependent on income, government spending might be dependent on income. This is, here we're just kind of wrapping all of that up. We're not kind of trying to break that down into the individual components, but we're saying there's some part of spending here that's not dependent on the level of GDP, and then there's some part that is dependent on the level of GDP. We represent it as a straight line because it's the simplest, and again, just because we don't want to get lost in the mathematics of this, we keep the maths really simple, but the basic story can allow for this thing to be more general than that. This autonomous spending is essentially something that we're just kind of using as a shifter to capture all of the different sorts of shocks that we've talked about. So it captures all the different sources of shocks to spending, including policy. It's both got kind of backward-looking components, so it might depend on accumulated wealth. It's also got a sort of all the forward-looking stuff there, kind of expectations and confidence that are in there. So we're wrapping an immense amount of stuff, if you like, into this autonomous spending piece. So a lot of what we're talking about, we're just saying we're going to capture that by shifts in this autonomous spending. So this is doing a lot of work, if you like, in terms of how we're trying to use this framework to understand the economy. So we've got this behavioral relationship, capturing all of this, and then we've got the accounting relationship, which just says that by the rules of GDP accounting, actual spending in the end is going to have to equal GDP. And then we have the equilibrium condition, which says that actual equals planned. That just means we're going to look at this point here. So the point where those two lines intersect is where actual spending equals planned spending. That tells us our equilibrium level of GDP. And when we do the mathematics of that, that gives us the result that GDP is equal to 1 over 1 minus the marginal propensity to spend. That's autonomous spending. This thing here is a multiplier which is greater than 1. And that tells us, in particular, if we think about that in terms of changes, it says if we have a change in autonomous spending, then the change in GDP is just given by the change in autonomous spending multiplied by the multiplier. So that's where we see the idea that a given shock to spending would lead to a change in GDP. So if we have a negative shock to the economy, something, maybe a fall in confidence or something like that, it causes autonomous autonomous spending to shift down. The whole spending line shifts down. Essentially what that says is that at this original level of GDP, which is now no longer in equilibrium, right? Because spending is shifted down. At this original level of GDP, now the demand, the amount of spending that people want to do, is less than the actual amount that firms produce. This is where firms see the inventory start to build up. So they suddenly find that they produce things, they have sales projections, they make production plans based on those sales projections. Then they found that actually they weren't selling as much as they expected to. So because of that, they see inventory start to pile up. When the inventory piles up, they respond to that by cutting their level of production. And so we go down to the new, this is the old equilibrium. We now go down to the new equilibrium level of GDP. And the multiplier effect comes from the fact that this decrease in GDP, this shift here, is going to be greater than this original shift in spending. Yeah. Oh, actual, just the actual spending. Think about it, if you like, as the actual supply. Roughly speaking, what's happened here is firms have decided to produce goods and services. Suddenly they're not able to sell them, so the supply is greater than the demand. There's an imbalance in the market. They see the inventory build up. They respond to that by cutting production. Yeah.
The equilibrium GDP,
Yep.
you might come to this later, the potential GDP, when you talk about that,
Mm-hmm.
are they the same thing, or are they...
So potential GDP is kind of long-run GDP. Okay, so often the way I've told this story is to say maybe we start off at potential GDP, okay, and then there's a shock that moves us away from potential GDP, and then we maybe talk about policy that might get us back to GDP. But in general, this holds for any level of spending, whether or not this can be an equilibrium. Given the level of spending, that can give us an equilibrium at different levels of GDP. Only one of those would actually correspond to kind of long-run potential GDP. Question up here? Okay. And then, so one thing you could say is, okay, what would happen if we did nothing? So what would happen if we didn't try to have any sort of policy response? Well, then we move from this to think about the adjustment of prices. So what's our story about the adjustment of prices? Well, our story of this comes down as follows. So let me again just kind of, let's start off, and going back to your question, by anchoring this in terms of the long run. Okay, so in the long run, there's a level of potential GDP, and this thing actually, is also moving through time, right? GDP is growing through time. And this kind of a long-run inflation level which I call autonomous inflation. And that long-run inflation, when the economy is functioning well, that long-run inflation is going to be largely pinned down. This autonomous inflation is going to be largely pinned down by kind of expected inflation. So we know that sort of in a picture there. I don't know. Anyway, okay. In Australia, the RBA has got a target of about 2 to 3% inflation. We know that they hit that target pretty consistently. Everybody understands that, which means that inflation expectations are pretty well anchored. In a well-functioning economy, inflation expectations are going to be pretty well anchored at that level that the central bank has chosen. So a lot of central banks, particularly the ones in sort of kind of well-functioning economies, tend to do inflation targeting these days. So we have central banks engage in inflation targeting, which means that they're able to set pretty good expectations of inflation. So autonomous inflation is kind of largely driven by inflation expectations. So I'm just going to call that key driver. Autonomous inflation. So this is where the economy sits in the long run. Okay? So it's a potential output with inflation at this long run level, anchored by inflation expectations. And so the picture you should have in your mind is, okay, GDP is kind of growing from time to time, GDP is growing through time, inflation is kind of nicely anchored there. And if we didn't have these short-run fluctuations to worry about, that's kind of obvious. But what happens in this situation where the economy actually goes down into a recession? Okay, so again, if we started off here imagining that we had started a potential output. So say this is a thought experiment. We'll begin a potential output, and then we'll say there's a shock to the economy, a spending shock. It pushes down spending, and it decreases GDP. So GDP now goes down to some new lower level. The question is, what happens to inflation as a result of that? Well, the answer to that comes from thinking about how the people who are actually responsible for setting prices and making pricing decisions, think about how they behave. So, marketing managers, pricing managers in firms, sort of how are they going to respond to this? Well, what's going to happen is a couple of things are going to happen. One is firms are going to see softer demand. Okay, so in a recession, firms are going to see that demand is somewhat softer. Very often, the best response to that will be to cut prices, or at least not have the same kind of price increases that you would usually have, or that you defer the price increase that you might normally have put in place. So at least relative to kind of expectations of inflation, you might decide that you're going to not increase prices so much, or you're going to hold prices fixed for a while. And that kind of comes from basic managerial economics. If there's a decrease in demand, and if you remember your MANEC well, you remember that actually it's not really just about whether there's a decrease in demand, but it's kind of about what that does to the elasticity of demand. But very often what we expect to see is that in a recession, what's going to happen is because of the decrease in demand, your best response to that would be to cut your prices. You'll have a little bit less market power than you had before, and so you'll respond to that by cutting prices. That's certainly, again, in the MANEC examples, in MANEC I know you would have worked for a lot of examples with linear demand curves, and with the linear demand curve, that would be the optimal response. The second thing that happens is the cost side of things is going to tend to go down. So again, from MANEC, we basically know that you can think about pricing as making a decision about sort of taking cost, the correct measure of cost, which is going to be marginal cost, and then pricing as a markup over that, where the markup depends on the elasticity of demand. So this is all kind of micro-based, this theory. Marginal cost is also likely to fall when we go into a recession. And it's going to fall for various reasons. It's going to fall because, perhaps most importantly, the labor market is going to become softer. So some people maybe have lost jobs. Some people, they're holding on to jobs, but firms are trying to decide whether or not they're going to kind of hold on to workers. So typically we're going to see wage increases being lower than they would otherwise be. The labor market is going to be soft, and that's going to be reflected in relatively low wage increases. So marginal cost is going to go down from the perspective of firms. And it's also going to show up for other inputs as well. So in general, when less is being produced in the economy, demand for inputs is going to fall. When the demand for inputs falls, the price of those inputs is going to fall. So marginal cost, as perceived by firms, is going to go down. So marginal cost has gone down. The optimal markup has very probably gone down as well. So the best response from a pricing point of view to GDP being below potential output is going to be to set smaller increases in prices. So this price adjustment, we should always think about it, is how inflation is responding to what happens to GDP. And so what we basically expect to see is some kind of relationship with a positive slope like this. When GDP is at potential output, inflation is going to be at its kind of expected or funds level. When the economy goes into a recession, we're going to tend to see inflation be low. The opposite will be true if the economy went into a boom. When the economy goes into a boom, you're tempted to increase your prices. Labor costs are going to go up faster than usual because the labor market becomes very tight. Other input costs are going to go up. So in a boom, we tend to see relatively high inflation. So we've got this kind of relationship between potential output and inflation. So, all of this was by way of answering the question, what would happen if we did nothing here? What would happen if we did nothing is that essentially inflation would start increasing, the inflation rate would go down. That would have the effect through various kinds of mechanisms of essentially forcing planned spending to start to shift back up again. And I don't want to go into too much detail on this. It's covered in one of the videos if you want to go back and kind of look at it. But basically the story is that the aggregate expenditure model is based on the assumption that there's some stickiness of prices in the economy. Not all prices adjust instantaneously. That's something that's pretty well supported by data. So we know that there's some stickiness of prices in the economy. Eventually, through kind of the mechanism here, prices will kind of, adjustment of prices would get us back, would start to shift spending back up. People would start to perceive themselves to be a little bit more wealthy and things like that. That would shift the spending line back up. And so, in the end, we will get back to potential output. So if we left the economy alone, we do think that eventually the adjustment of prices in the economy, coming from this kind of story, would get us back. But that process may be quite slow and inefficient. So then the idea is that we can potentially use economic policy to try and shift spending back. The economic policies that we can use, we can either use a monetary policy of cutting interest rates to try and boost investment spending and to a certain extent consumption spending, or we can use fiscal policies of trying to increase government spending or cut taxes in order to encourage consumption. All of these policies are just about shifting autonomous spending. Okay, so anytime we think about these kinds of policies here, changing interest rates, changing government spending, changing taxes, ultimately what we are trying to do is to have changes in the different components of spending. Changes in consumption, government spending, investment spending, and then exports. So the policy response is also all about trying to change the level of spending in the economy to shift the planned spending line back up and get us back to equilibrium. Okay. Why don't we just take like a 2-minute break here, just for me to catch my breath and you to catch your breath, and then I'll talk about a few other things.
Because that's what's going to happen. So.
So let me say a few things now about monetary and fiscal policy. So, in a way, fiscal policy, at least in terms of execution, there's not a whole lot to say about it in the short run sense. I'll come back to the sustainability issue in a little bit. But in the short run sense, fiscal policy is conceptually very straightforward, right? And fiscal policy consists either of the government deciding it's going to spend more money, or the government deciding it's going to cut taxes to encourage consumers to spend more money, or perhaps the government deciding it's going to increase transfer payments, unemployment payments, other welfare payments and things like that, again, to encourage consumers to spend more money. So fiscal policy, in terms of its effect on spending, there really isn't anything sort of deep or complicated about that. Government spending just is a component of spending. Policies around taxes and transfers are pretty directly aimed at affecting consumption, which is one of the other components of spending. Monetary policy is a bit more subtle because monetary policy, as was pointed out earlier, starts off from controlling some very short-run nominal interest rate. In Australia, that's the cash rate. But in the end, is only going to have an effect through longer-run real interest rates. So we're kind of up at the top of the circle, as I described this, we've got kind of the RBA making its decision on the first Tuesday of every month. In the US, the Federal Open Market Committee makes its decision about monetary policy and choosing a short-run nominal interest rate. Now, in fact, strictly speaking, they just choose a target rate and then do their best to conduct policy in a way to sort of meet that target. But actually, they're pretty good at meeting that target. They meet that target typically by conducting what are called open market operations, which are essentially purchases or sales of government securities. So if they want to cut interest rates, then what they want to do is they want to essentially, if we think about it in terms of the credit market, there's a supply and a demand of credit. If they want to cut interest rates, then what the Reserve Bank wants to do is basically to increase the supply of credit in the economy. We talked way back at the start of the term about how kind of the flip side of a credit market is going to be an asset market. So the flip side of this transaction in the asset market would be that the firm would, the Reserve Bank would demand purchase government securities, purchase government bonds. And so you can think about this in two equivalent ways. They're both the same thing. So an open market operation consists of purchasing some government bonds that is going to increase the price of bonds. Equivalently, it's supplying more credit to the economy. Essentially what's happening is that by exchanging money for bonds, they're taking the bonds out of the private sector and they're putting money in there instead. So now that money is out there ready to circulate in the economy. And so that has the effect of reducing interest rates. There's a bit more that goes on in terms of what's sometimes called a money multiplier process. Once the banks have got some more money in their hands, then they lend that money out. Some of it gets deposited back in the banks and gets lent out again. So the original purchase by the central bank kind of gets multiplied up into a larger effect of credit. But that's not something we need to worry about too much. The basic point here is that the RBA decision essentially allows them to affect this short-run interest rate in the economy. And then
Sorry, Andrew.
Yes.
So I was about people buying bonds. Who's buying them?
the RBA, the Reserve Bank. So this is a monetary, and here I'm talking about a monetary expansion. This is all reversed if you're talking about a monetary contraction. But in a monetary expansion, essentially what the RBA is doing is it's carrying out these open market operations. What it's therefore doing is meaning, because it's putting more money in the hands of the banks, and they act, they basically act on these sort of exchange settlements accounts that the banks use to balance their books at the end of the day. Because when they put more money into the bank's accounts through that process, the banks have less need to borrow from each other at the overnight rate. So a bank that has a shortfall at the end of the day is not going to need to borrow so much from other banks. So, a bank would have less of a shortfall, so it wouldn't need to borrow so much from other banks. So the interest rate which clears that overnight market between banks is going to be lower. So that's the cash rate. And then we hope that this then has an effect, and it does pass through to a long-run real rate. And there are kind of two pieces to that mechanism. One is the so-called yield curve. And the yield curve is what tells us that short interest rates and longer interest rates are going to tend to be linked to each other. So when the Reserve Bank acts at the sort of the lower end of the yield curve, so if we talk about interest rates of bonds, of assets more generally of different maturities, we typically see it kind of sloping up like this. The Reserve Bank is kind of acting down here on the cash rate, which is a very short interest rate. It's an overnight interest rate. If they push that down, typically what we see is the entire yield curve, the entire spectrum of interest rates being moved down. So longer term interest rates, which are the ones that are going to matter for firms' investment decisions and for households' consumption and saving decisions, those are also going to be moved. The other thing is to go from the nominal to the real rate. We have to have the Fisher equation, which relates the real interest rate to the nominal rate and the expected inflation rate. And this is kind of at least in reasonable times, again, kind of reasonably well anchored. I shouldn't say literally pinned down because it can change. You can phrase that slightly. But that's kind of anchored by the long-run policy of the Reserve Bank. Okay, so they act on this short-term nominal rate, but then through inflation expectations and the yield curve, we end up seeing a long-term real rate being affected. That long real rate is therefore going to affect consumption and investment spending. Okay, so if then if we go back to the credit market here, the lower interest rate means that there's going to be more demand for funds by firms for investment purposes. It also means that households are going to want to do, tempted to want to do more consuming and less saving, because they're now seeing a lower return on their saving. Lower interest rates means a lower return on their saving. So in equilibrium, that means we end up with a larger amount of both investment spending and consumption spending, and therefore, in the end, we have an effect on GDP through the aggregate expenditure model. So this piece of the story is kind of the aggregate expenditure model. We've then got price adjustment, which determines the level of inflation in the economy. So our price adjustment story that we had there. And then the Reserve Bank looks at the data. Most importantly, it looks at these two pieces of data. And then follows what we often call a Taylor rule, which basically says if inflation is too high above the target, you're going to want to increase interest rates. If inflation is too low, you're going to want to decrease interest rates. If GDP is above potential, you will increase interest rates. If GDP is below potential, you will decrease interest rates. So that kind of tells you that what the policy response is going to be when the Reserve Bank observes the data on the economy, and that feeds back into their next decision. That's left out a couple of things. First of all, it's left out the lags that were mentioned before. So there are lags associated with economic policy making, and I told you about 3 types of lag. The recognition lag, which is just noticing that there's a problem there in the first place, and that can take a while because the data that we get often come in, are telling us about the historical economy, not the economy as it is today. Then there's the so-called inside lag, which is enacting policy. And that's very quick from monetary policy. The Reserve Bank just can change the interest rate, can change the cash rate whenever they like. It's rather slower for fiscal policy, because typically fiscal policy changes, at least in a democracy, kind of have to go through a sort of a parliamentary process. And then there's the outside lag, which is how long does it take for the policy to have an effect. Now, for fiscal policy, that's pretty quick. Fiscal policy can have an effect almost immediately. Fiscal policy can even sometimes have an effect, when it's announced. So if the government tells you that they're going to cut taxes in the future, and if you believe the government, then you would perceive yourself as being richer right away, and that might affect your consumption right away. So you can potentially have a big effect, or at least you can have an effect of fiscal policy from announcements as well as from the actual spending. So, so fiscal policy doesn't have much of an outside lag, but it does have the big inside lag. Monetary policy doesn't have the inside lag. You can enact it quickly, but it can take quite a while for that to get passed through into these decisions down here. It can take quite a while for monetary policy decisions to actually show up in the form of changes in consumption and investment spending. So part of the skill of being a central banker is kind of working out when you've made your policy changes, to what extent they have had their effect in the economy, to what extent they're still working their way through the economy. So this is kind of this is the picture you should have in your head of how monetary policy works. It's essentially this sort of cycle of making a decision, seeing that pass through, affecting the economy, looking at the state of the economy, responding to that, and making another decision. Yeah.
What are the debates, when inflation is based on expectations, how much we can have on people? Is there any thought to lowering interest rates, basically demonstrate to everyone that the expectations are poor, that might actually have negative impact?
So lowering interest rates has an effect.
This is, one of the things we've been saying is that, the government or the expectations are set around the long-term inflation rate in order to kind of exit it. And expectations have a lot of impact on long-run output. So when the central bank reduces the interest rate, it's basically demonstrating that there's not a lot of confidence in the market. So has that had a negative impact?
So, I mean, there's a few different things that you could be talking about here. So I'm trying to work out which one it is. So let me try this answer first, and let's see how well that works. So one thing that's certainly true is that the Reserve Bank and the Fed and other central banks also have an effect on markets and on interest rates and particularly on inflation expectations by the language that they use and the speeches that they make and so on and so forth. And I think I may have quoted in class sort of some of the passage from Ben Bernanke's book where he actually talks about how they started to try and really give clear signals about not just current monetary policy, but about future monetary policy, therefore about future interest rates, and those words were reflected in movements in actual interest rates. Now, that can have an effect potentially also through expectations of inflation. So depending on if perceptions of expected inflation change, then absolutely that becomes a problem for the central bank to deal with. And it's probably the case, for example, in the US right now, that because inflation has been so low for so long, that expected inflation is kind of sitting below where they would actually like it to be. And they'd actually like expected inflation to be a bit higher to push down real interest rates. So that's one effect that you can get. Another effect that you can get is, people can look at what the Fed or the Reserve Bank does and think, they've just decided to cut interest rates. They must know something that we don't know about the state of the economy. They must be concerned about the state of the economy, and therefore that makes people less confident about the state of the economy. So that certainly can be an issue, and that's sort of another one of those kind of fine lines they sort of have to tread, that potentially their actions can have effects on confidence as well. So, okay. All right, so I said there were two things I sort of left out of this story here. One is the lags. The other is the international component. And the international component is what's going to allow us now to kind of talk more about exchange rates and how they fit into this whole story, and more generally, how exchange rates fit into monetary policy decision making. one of the things that I kind of wanted you to understand in this course is that interest rates and exchange rates sometimes may seem a little bit mysterious, but ultimately they're just prices. And because they're prices, they're determined in the way prices are kind of always determined by supply and demand. Okay? So interest rates are determined by supply and demand in the credit market, and in an aggregate sense, we think about the supply of credit as coming from household saving in the economy and perhaps money coming in from overseas, and the demand for credit is coming maybe for the government to finance its deficits and also for firms to finance investment. But in the end, the interest rate depends upon that supply and demand for credit. And when the Reserve Bank wants to go in and affect the interest rates, what they're really doing is they're just acting in that market to affect the supply of credit. Likewise, the exchange rate is determined in a market, and it's determined in the market, which is the supply and demand for the currency. So, the exchange rate, as I've always defined it, is the price of the domestic currency. The demand for the domestic currency comes from people who want to buy our goods. So if they want to buy our goods, our exports, they have to purchase our currency. And people who want to buy our assets. Just for simplicity, I'll leave out the income account version. There's also, if people want to kind of, if foreign investments are paying interest payments to domestic consumers, that would also be a component of the demand. But that's less important and less interesting for what we want to talk about. So the most important thing is the demand for the currency comes from exports and from people wanting to buy our assets. So when people want to buy our stuff, our goods and services, or when people want to buy our financial assets, they demand our currency. Likewise, if we want to buy other people's stuff, or if we want to buy other countries' assets, that's going to show up in the supply of the currency. And any movement in the exchange rate ultimately has to come down to changes in the supply or the demand. So, what does this have to do with monetary policy? Well, there's an additional channel to the monetary transmission mechanism which operates through exchange rates. So if the Reserve Bank cuts interest rates, what that is going to do is that's going to mean that our domestic assets are now going to look less attractive to foreigners. Okay? So our assets look less attractive to foreigners, so we'd expect to see a decrease in foreign demand for purchase of domestic assets. And by the same token, we're also going to want to purchase more overseas, more assets overseas, because relatively speaking, overseas assets are going to be paying a higher return than Australian assets. So we'd expect to see the demand shift back because foreigners want to buy fewer of our assets, and the supply shift out because we want to buy more of foreign assets. So both of those things work to reduce the exchange rate. And then that's going to tend to encourage net exports, both exports and imports. So I wrote it there in terms of the nominal interest rate and the nominal exchange rate, but exactly the same logic would go through from the real interest rate to the real exchange rate to net exports. So there's an additional piece of the monetary transmission mechanism that operates through an international channel. When we cut interest rates, we're also going to tend to push down the exchange rate, and therefore we're also going to encourage net exports. All of this, of course, is on the basis of a floating exchange rate. We'll come in just 1 second to the case of a fixed exchange rate. Yeah. Yeah, exactly. Because the returns are low. Now, I've also explained this link between interest rates and exchange rates through a somewhat different story, which is the uncovered interest parity story. So let me just kind of remind you of that. So what's the story there? The story is that, first of all, we define the purchasing power parity exchange rate which is kind of a long-run anchor for the nominal exchange rate. It's kind of saying if the nominal exchange rate was at that level, then the same bundle of goods in two different countries would cost the same amount once you convert it at this exchange rate. And we think about this as being sort of a very long-run anchor for the exchange rate. The actual exchange rate can depart from the purchasing power parity exchange rate for very long periods of time, for years, for decades. It's an absolutely terrible story of, predicting tomorrow's exchange rate. If you want to predict the exchange rate 20 years out, this is kind of where you would start from. Okay, so we've got a notion of there being some long-run anchor for the exchange rate. So let's suppose the economy is kind of buzzing along at this purchasing power parity exchange rate. And then let's suppose that at this date here, we have a cut in the interest rate. Well, what uncovered interest parity tells us, if you remember, is that we think the expected change in the exchange rate should reflect interest rate differentials. The logic for that is kind of a quasi-arbitrage argument. The logic for that is sort of pretty straightforward. For example, if Australia is offering, say, higher interest rates than the US, then if you didn't think there was any possibility of the exchange rate changing, then you'd say, I have a money machine here. I just borrow in the US at the low interest rates, I invest in Australia at the high interest rates, and I make clear profit. Now that's actually not guaranteed. This is what we call carry trade, and people do sometimes make profits out of this. But they're not guaranteed profits because the risk you take if you borrow in a country with low interest rates and lend in a country with high interest rates is over the time that it takes for that high interest rate to pay off, the currency of the country may have depreciated. And so exchange rate depreciation might wipe out your interest rate gains. An uncovered interest parity is the condition where those things would be exactly in balance. So any interest rate differential will be exactly matched by expected exchange rate changes, so there would be no sort of expected profit to be made from the carriage. So what does that mean? So if we were starting off at this purchasing power parity exchange rate and everything was kind of fine, and that's the long run anchor, and then suppose we cut our domestic interest rate. Okay? If we cut the domestic interest rate, so this thing goes down, it's got a negative sign attached to it, so that means we're now going to expect appreciation. We now expect there to be an increase, or we expect there to be appreciation of the currency in the future. So we've been buzzing along here. Suddenly the interest rate is cut. And now we know that in the future we've got to expect appreciation of the exchange rate. But we also expect that in the end the exchange rate is going to get back up, it's going to be at this level here. So for there to be appreciation of the exchange rate in the future, and for this still to be our long run anchor, what has to happen is that the actual exchange rate has to drop and then kind of work its way back up again. So the logic of uncovered interest parity, although it's kind of a bit more complicated because it's kind of a forward-looking arbitrage story, is completely consistent with what we've said over here. It says if you cut interest rates, you'd expect there to be a fall in the exchange rate. And here we told the story just in terms of the supply and demand for the currency in a straightforward way. Here we're also saying there's going to be sort of this expectational and forward-looking piece of this, which is going to match up as well. But it's really just sort of two different ways of looking at the same story and giving us the key bottom line conclusion that we expect interest rates and exchange rates to move in the same way. We've also talked briefly about fixed exchange rates and flexible exchange rates. So this story here, of course, is one of fixed exchange rates, flexible exchange rates. But we can also have a policy where the central bank decides to fix the exchange rate. And what a fixed exchange rate essentially means is that the central bank has to look at whatever the demand is for the currency, and it has to ensure that the supply matches up. So in particular, if sorry, I should have said that the other way. The central bank the way we usually think about this is the central bank is going to adjust its demand for the currency in order to ensure that demand and supply are. I've been talking too long. We can tell both stories. So let me tell both stories. So, for example, we can ask what's going to happen if maybe people in the economy are sort of worried about the value of the currency, the stories we tell about speculative attack or things like that. So suppose people start wanting to sell off the currency. So we have a supply, an increase in the supply of the currency. Then the central bank has got to say, okay, you want to sell the currency, you want to sell the currency and get foreign currency in exchange. So maybe we're pegged to the US dollar, you want US dollars, then that's fine. We will give you the US dollars and we'll buy the currency from you. So the central bank would say, yep, if you want to increase your supply of the currency, we will match that with an increase in demand, so the exchange rate stays at the same level. That's one story. The central bank will adjust its demand for the currency in line with changes in supply. Equally, if perhaps there's an increase in the demand for the currency, which in other circumstances would tend to cause the exchange rate to appreciate, so that increase in the demand for the currency could come about perhaps because more people want to purchase the exports of the currency. So then the central bank is saying, okay, you're coming in here with your US dollars and you want to buy our currency. Absolutely, you can have our currency. We will increase our supply in line with that, again, to keep the exchange rate constant. So, what a fixed exchange rate means is that the central bank has given up control over the demand and the supply of currency, of money, because what it is doing is it is saying we will supply to the markets or purchase from the markets as much or as little as is desired. We're just going to respond to whatever the market demands and supplies are for this currency, and we will meet those with our own operations in order to keep the exchange rate fixed. So the central bank, if it adopts a fixed exchange rate, gives up any control over monetary policy. We can also see that through the uncovered interest parity relationship. A fixed exchange rate means that we don't expect any change in the exchange rate, obviously, which means that the domestic interest rate has just got to be the same as the foreign interest rate. So we've lost control over interest rates, we've lost control over monetary policy. And this gives us the so-called impossible trinity, which says that basically you can't have fixed exchange rates and an independent monetary policy unless the only way you can have both of those things, fixed rates and still have some control over monetary policy, is if you decide to impose capital controls. If you impose capital controls, you can kind of break this uncovered interest parity link because now money can't flow freely in and out of the country. But essentially, there are three things that we think might be desirable. One is fixed exchange rates because they make business planning and investment planning easier. One is free movement of capital because we think that tends to make most of the time economies function more efficiently. And one is control over monetary policy because we think that's a useful thing to have. But it turns out you can't have all three of those things. You can be like Australia and have flexible exchange rates instead of fixed. You could be like, say, Argentina in the case we studied, which gave up control over monetary policy. It went to fixed exchange rates but gave up control over monetary policy. Or you could be like China, at least sort of up to the point where they started liberalizing, where they started trying to make the yuan convertible. Before that, they had basically fixed exchange rates. They had monetary policy, but they had capital controls in place. You've got to let one of those three things go. Yeah. So essentially what will be happening is that if the demand for the currency, so let me sort of explain it in two ways. So in intuitive terms, what's happening? Okay, this is literally what's happening. In intuitive terms, what's happening is that people are coming to the central bank and saying, we want your pesos. Here are our US dollars. Give us pesos. So the central bank is going to hand over pesos in exchange for the US dollars. Where are those pesos coming from? They might be coming from the vaults, or they might be something that they might be money that they choose to create. Again, So they could be printing money. Now, as a practical matter, what they would be doing is they'd be seeing the value of the they would be seeing the upward pressure on the exchange rate, and so they would kind of be acting with the sort of the kind of open market operations and things that we talked about before to put more money into the economy. So they would be basically, for example, purchasing government bonds to sort of put more money, put more liquidity into the economy, which would have the same effect. Okay. But intuitively what's going on is basically the central bank is just kind of handing over it's handing over the peso. But yeah, I mean essentially it is creating money in the way that central banks create money and put it into the economy. Okay, I haven't talked at all about the practice exam, and I'd like to do that, so let me just move to that. And there's not going to be a lot for me to say sort of beyond, I think, what is in the brief solutions that I put up on the website. I guess what I want you to take away from looking at those solutions is, typically speaking, I'm not looking for long and detailed answers, and I will give you the exam in a form where you will actually be writing in your answers on the exam, so I'll just give you an indication of kind of how much space I expect you to take up. Most of the time, for these short answer questions, I would think that 3 or 4 sentences would be enough to answer it. So, for example, the first question here said, I talked about our definition of competitiveness and then referred to the fact that in the case there were measures that were undertaken to increase Colombia's competitiveness, and I just wanted you to interpret those measures in terms of how we have talked about competitiveness in terms of the return on capital, the marginal product of capital. So you could talk about some of the things that were talked about in the case were sort of the trade liberalization and joining the WTO, and those are things that would make it easier for companies to get the inputs they need. It would make it easier for them to have access to the export markets that they want. Those things would increase the profitability of firms, therefore they would make the country more attractive for investment, they'd increase competitiveness. Similarly, reducing regulation on financial flows was another thing that was mentioned. That makes it easier for firms to raise funds in international markets. It makes it easier for firms to repatriate profits when they want to. Again, those are things that would tend to increase the profitability of firms, therefore increase the marginal product of capital. And likewise, flexibility in the labour market, the effect that would have. So, I mean, there what I wrote was 7 sentences, and that was, longer than most of what I'd expect. What I'd be expecting to see from you there is identifying what the measures were and making the connection from those policy changes to a measure of competitiveness, which is the marginal product of capital. Had a question about the structural deficit, which is not a term I used in class, but I defined in the question here. It's the deficit that we expect to see when the economy is at potential output. So the notion here is that, look, the deficit changes as a matter of policy, but the deficit also changes to a certain extent in automatic ways. And we did kind of talk about that in class this week. So, for example, when the economy goes into recession, we talked about how, in the case of Greece, one of the consequences of austerity policies, when the economy goes into recession, you get less tax revenue, so that makes your deficit worse. And that, we sometimes parcel that out, so that's not the structural deficit. The term that's sometimes given to that is the cyclical deficit. And so this question was asking you just to kind of recognize how that kind of connection might take place. Third question Colombia achieved control of inflation at 2.9% due to the central bank's inflation targeting regime and flexible exchange rate. And I asked the question, what can we conclude from this sentence about whether capital controls are needed in Colombia? So that's about this impossible trinity. They've told us in the sentence that they're targeting inflation. So they've got an independent monetary policy, and they've got flexible exchange rates, so not fixed exchange rates. So we know then that's kind of we know they don't have to have capital controls. Okay, if they had fixed exchange rates and monetary policy, we'd know they have to have capital controls. But since they've got flexible exchange rates, we can infer from that they don't need to have capital controls. Doesn't mean they don't necessarily have some in place, but they don't need any. Question 4, case states, according to the government of the central bank, the autonomy of the central bank ended decades of moderate to high inflation. So I wanted a brief discussion of why central bank independence matters for the control of inflation. So there you can go back, you could think about the Argentina case, and we know that that if the central bank is not independent, then the government may use the money creation processes and the money creating ability of the central bank to generate seigniorage revenue and therefore generate too much inflation. So the independence of central banks is generally thought to be sort of a good thing, because it means that control over monetary policy is out of the hands of the politicians. The politicians might have a tendency to use it for sort of personal political gain. Also goes back to Charles's point much earlier about, if the politicians had control over monetary policy, they'd constantly be saying, we're coming up to an election, let's increase the money supply and generate a boom. But if you keep doing that, what you eventually do is you just generate more and more inflation in the system. That inflation starts to get expected, and autonomous inflation shifts up, and you just end up with more inflation without having more output in the long run. So generally speaking, we think that independence of the central bank is good for having control over inflation. There's a figure in the case that shows a growth accounting breakdown for Colombia. And I asked, explain how it's possible for labor productivity to grow even if total factor productivity is falling. So there I'm just checking your understanding of the two different forms of productivity. Total factor productivity is A in the aggregate production function. So in this story, that's falling. But labor productivity is output divided by labor hours, okay? And that is affected not just by A, but it's also affected by physical capital and human capital. So if physical capital has been increasing and human capital has been increasing, then that means that workers are able to be more productive, in the sense that output per worker hour would go up, and provided that's big enough, that could offset the fall in total factor productivity. So that's just about understanding that mechanism. Question about understanding just real interest rates and changes in the exchange rate. So really, question 6, looking at data in the case, just making sure you understand what the real interest rate is and interpret its movements by looking at the nominal interest rate and the inflation rate, and also that you understand the definition of sort of appreciation and depreciation of the exchange rate, and you can understand what that means, given that exchange rates can be defined either way, as price of domestic currency in terms of foreign currency, or price of foreign currency in terms of domestic. Question about sort of the accounting of national saving as a percentage of GDP. So essentially this was sort of a question about just understanding the basic national accounts, and how in this particular case we've got negative net exports, which corresponds to borrowing from the rest of the world, and how that also shows up as there being also shows up in terms of the fact that domestic saving is not enough to finance overall domestic investment. So if we think about sort of the idea of the circular flow here, essentially what we're saying with the government and the households together is there isn't enough saving here to provide all the investment we need, so we know that some money also has to be coming in from the rest of the world, and that money coming in from the rest of the world is equivalent to us having a trade deficit. In other words, the exports coming in here are less than the imports flowing out of our economy. So we've got money flowing out of our economy in terms of imports, some money flowing back in terms of exports, but some of that money flowing back in terms of foreigners purchasing our assets and therefore lending to us. Question 8 is also kind of an accounting question about the primary deficits and the unified deficits that we talked about in class this week. So that's just understanding how we sometimes want to make a distinction between the deficit excluding interest payments and then the deficit, the unified deficit when we include interest payments. So I think those questions are relatively straightforward, sort of in accounting terms. Question 9 is about, can you read the basics of the balance of payments? So just asking if you can look at the net foreign asset position, and we can infer that by understanding that Colombia's income account is negative. So the income account, if you remember, is basically the interest rates on net foreign assets. So the income account in the balance of payments we think of as interest times net foreign assets. So if that income account is negative, that tells us that our net foreign asset position is negative, barring something like really weird like happens in China. You can look at the case and hopefully you'll be able to see the trade balance is positive, that exports exceed imports, and there's a question about the always that tricky line on the balance of payments, which is the change in reserve assets. When that number is negative, remember the balance of payments are always capturing the flows of money. When the change in reserve item is negative, that negative means money going out of the country. So that means the central bank is sending money out of the country and acquiring with that money foreign reserves, US dollars, euros, whatever. So a negative number on that bottom line of the balance of payments is always an acquisition of reserves. And then question 10, the commodity boom threatened the competitiveness of non-mining sectors by causing the exchange rate to appreciate. So that's kind of the story we've talked about a little bit in Australia, the so-called Dutch disease story. Draw a supply and demand diagram to explain why the commodity boom led to exchange rate appreciation. Again, nothing very complicated there. Merely saying, okay, the commodity boom means that people were buying Colombia's exports, so there's an increased demand for exports, which will push up the value of the exchange rate. So I hope that these short answer questions are relatively straightforward. And as I say, in most cases, I think just a few sentences will be able to answer. They're really testing your sort of comprehension of basic concepts in the course, and in particular your ability to apply those to the information in the case. So, therefore, in a way, what I'm testing is the extent to which I've succeeded in this course in helping you to look at data on countries, make sense of it, understand it, think about what it means in terms of what's actually going on. And then part B Part B was just this very open-ended one. Would you invest in Colombia? And look, really, that's just a matter of going through the case, and there's a bunch of things that are positive and a bunch of things that are negative. I'm really just looking for you to sort of go through the case information, both the text and the data, and see what seems useful. And I listed about a dozen points here, but it's not a complete sort of right and wrong. And some of those points were positive, some of those were negative. Yeah. Yeah. Bullet points would be fine, provided there's explanation.
Do you think of any structure to that analysis? As in, people would usually do it this way, looking at this and that.
So, it's true. My answer there is kind of very unstructured, and a structured answer would be better. I think a structured answer would probably, the simplest way to structure the answer would be to say, look, here are the positives. Here are the things that make Colombia look pretty attractive right now. Here are the sort of those positives. Might be sort of recent economic performance, which looks pretty strong. Government finances looking pretty good, things like that. And then some of the negatives would be things like the poor physical infrastructure, the fact that we're not seeing much in terms of sort of research and development and these other things that go into capital A. And then some things that are maybe sort of in the middle, so the social infrastructure stuff, there's a whole bunch of things that we might look at in terms of the ease of doing business. Some of those look quite positive, some of them look quite negative. There's considerable uncertainty about some of them. Has Colombia really kind of made significant improvements in its kind of crime and terrorism issues, or are those still open? So that would be the most obvious structure. The things that are positive, the things that are negative, the things that are less clear or have a lot of uncertainty. Make sense? All right, I've talked at you for a long time here. I hope this was helpful. On Monday, we'll just have a lot more chances to see the way you have gone through the process of studying countries and learning about them. And I think and hope that process has been beneficial to you, the process of doing your syndicate projects. And certainly on the evidence we saw last week, the bar has already been set quite high for those of you who are going in the next couple of days. So I'm looking forward to seeing you all on Monday and Tuesday.